Gold just hit $4,000 an ounce. And if you're watching this right now, you need to understand something critical. This isn't just another price milestone. This is a warning signal that most people are completely missing. Because while everyone's debating whether to buy the new iPhone or upgrade their car, there's a massive shift happening in the global financial system that's going to change everything about how wealth works. And the people who understand what's happening right now are making a very specific move with their money. Let me show you what I'm talking about. Right now, central banks around the world are buying gold at a pace we've never seen before. In the third quarter alone, they purchased 220 tons. That's a 28% increase from the previous quarter. But here's what makes this absolutely fascinating. They're doing this while gold is at all-time highs. Think about that for a second. These are the most sophisticated financial institutions on the planet, with access to every piece of economic data imaginable, and they're buying gold at $4,000 an ounce like it's going out of style. Why would they do that? What do they know that the average person doesn't? The answer is actually pretty straightforward when you look at what's happening beneath the surface. We're witnessing the largest wealth transfer in modern history, and it's happening so gradually that most people won't realize it until it's too late. Let me paint you a picture. Imagine you're at a party and everyone's having a great time. The music's playing, drinks are flowing, everything seems perfect. But there's a small group of people quietly heading toward the exits. They're not making a scene. They're not panicking. They're just leaving. And if you're paying attention, you might wonder, what do they see that I don't? That's exactly what's happening in the financial markets right now. While most investors are still piling into stocks and bonds, treating the dollar like it's invincible, central banks are quietly accumulating physical gold at record levels. They're heading for the exits, and they're not being subtle about it anymore. China's central bank has been on an absolute buying spree. They've been adding to their gold reserves month after month, and here's the thing. Those are just the official numbers. Many analysts believe China's actual gold holdings are significantly higher than what they report. Why would they underreport? Because they don't want to trigger a panic or drive prices up too quickly while they're still accumulating. Russia's doing the same thing. India's doing it. Turkey's doing it. Poland's doing it. Even countries you wouldn't expect are loading up on gold. This isn't a coincidence. This is coordinated de-dollarization happening in real time. Now you might be thinking, okay, but what does this have to do with me? I'm not a central bank. And that's exactly the point. You're not a central bank, which means you don't have the same resources, the same information networks, or the same ability to weather financial storms. Which is precisely why you need to pay attention to what they're doing. Because here's the reality. When central banks move, they're not reacting to what's happening today. They're positioning for what's coming tomorrow. And what's coming is a fundamental restructuring of the global monetary system. Let's talk about what's actually driving this. The United States has been running massive deficits for years. We're talking trillions of dollars in debt that keeps growing. And the way we've been managing this debt is by printing more money. It's like trying to solve a credit card problem by getting more credit cards. Eventually, the whole thing collapses. But here's where it gets interesting. For decades, the dollar's been the world's reserve currency. That meant everyone needed dollars to trade internationally, especially for oil. It was a brilliant system if you were the United States, because you could essentially print money and export your inflation to the rest of the world. Other countries had to hold dollars, which meant they were funding our deficit spending whether they liked it or not. That system is breaking down. And it's breaking down fast. The BRICS nations, that's Brazil, Russia, India, China, and South Africa, plus a growing list of other countries, are actively working to create alternative payment systems that bypass the dollar entirely. They're settling trades in their own currencies, they're building new financial infrastructure, and they're backing it all with gold. This is why gold's at $4,000 and climbing. It's not speculation. It's not a bubble. It's a fundamental repricing of what real money actually is. Let me give you a specific example of how this plays out in the real world. There's a reason why gold mining companies can't keep up with demand right now. Physical gold is becoming increasingly difficult to source in large quantities. The premium you pay for physical gold over the paper price has been widening, That spread tells you something crucial. There's a shortage of actual physical metal. See, there are two gold markets. There's the paper market, where contracts and derivatives trade on exchanges like the COMEX, and then there's the physical market, where actual bars and coins change hands. For years, these two markets moved in lockstep, but they're starting to diverge, and when that divergence becomes too large, something's got to give. The paper market is massive. There are claims on gold that far exceed the amount of physical gold that actually exists. It's like a game of musical chairs where there are 100 people, but only 10 chairs. As long as everyone believes they can get a chair when the music stops, the game continues. But the moment people start demanding their chairs, demanding physical delivery instead of paper promises, the whole system seizes up. We saw a preview of this during the banking crisis. When Silicon Valley Bank collapsed, there was a brief moment where people started questioning the stability of the entire financial system. And what happened? Gold spiked. Not because of inflation, not because of interest rates, because people wanted something real, something that couldn't be printed or promised away. Now, here's where this gets personal for you. If you have money sitting in traditional retirement accounts, in 401ks or IRAs, that money is almost certainly invested in paper assets, stocks, bonds, mutual funds, and those assets are denominated in dollars, which means your retirement is directly tied to the value of the dollar and the stability of the financial system. What happens when that system shifts? What happens when the dollar loses its reserve currency status? What happens when those paper promises start getting called in? I'm not trying to scare you. I'm trying to show you what the smart money is already doing. They're diversifying out of pure paper assets and into hard assets that have held value for thousands of years. Quick aside here, if you're sitting on a significant amount in retirement accounts, there's actually a way to get physical gold into those accounts without triggering tax penalties. It's called a gold IRA, and I put together a free guide that explains exactly how it works. It's in the description below. Worth checking out if you want to understand your options. No pressure, just information. Anyway, let's get back to why this matters right now. The supply and demand dynamics for gold are absolutely fascinating when you dig into them. On the supply side, gold production has been relatively flat for years. It's not like oil where you can just drill more wells. Gold mining is incredibly capital intensive, and the easy deposits have already been found. New discoveries are rare, and bringing a new mine online takes years, sometimes decades. Meanwhile, demand is exploding. You've got central banks buying, you've got institutional investors buying, you've got wealthy individuals buying, and increasingly, you've got regular people waking up to what's happening and wanting to protect their wealth. This creates a fundamental imbalance. When demand outstrips supply in any market, prices rise. But with gold, there's an additional factor. It's not consumed. Almost every ounce of gold ever mined still exists somewhere. It gets recycled, melted down, reformed, but it doesn't disappear. So the question becomes, at what price will current holders be willing to sell? And here's the thing. Central banks aren't sellers. They're buyers. They're taking gold off the market and locking it away in vaults. That permanently reduces the available supply. It's like a one-way valve. Gold flows in, but it doesn't flow back out. Some analysts are predicting gold could hit $5,000 within the next year. Others are talking about $10,000 in the next few years. Are they right? Nobody knows for certain. But what we do know is that the fundamental drivers pushing gold higher aren't going away. The debt isn't shrinking. The money printing isn't stopping. The de-dollarization isn't reversing. Let me tell you about what happened in the 1970s because there are some eerie parallels to today. Back then, the United States was running large deficits because of the Vietnam War and Great Society programs. Inflation was rising. The dollar was under pressure. And in 1971, President Nixon did something unprecedented. He took the dollar off the gold standard completely. Before that, dollars were theoretically redeemable for gold. After that, they were just paper-backed by nothing but faith in the government. And what happened to gold prices? They went from $35 an ounce in 1971 to over $800 an ounce by 1980. That's a 2,200% increase in less than a decade. Now, I'm not saying we're going to see that exact same move. The circumstances are different, but the underlying dynamics are remarkably similar. We have massive deficits. We have inflation. We have a dollar that's losing credibility on the world stage. And we have gold breaking out to new all-time highs. The difference is that this time, the move might be even more dramatic. Because in the 1970s, the dollar was still the undisputed reserve currency. Today, that status is being actively challenged. The world is multipolar now. There are alternatives, and those alternatives are being built on a foundation of gold. Here's something most people don't understand about how gold actually trades. The COMEX, which is the major exchange for gold futures in the United States, operates on a fractional reserve system. That means they have far more paper claims on gold than they have physical gold in their vaults. It's legal. It's how the system works. But it creates a massive vulnerability. If even a small percentage of contract holders demanded physical delivery instead of cash settlement, the exchange couldn't fulfill those demands. They'd have to default or suspend trading, and that would send shockwaves through the entire financial system. This isn't conspiracy theory. This is how the market is structured, and it's why the people who really understand gold markets are buying physical metal, not paper contracts. They want the actual asset, not a promise to deliver the asset. There's also the industrial demand side that people often overlook. Gold isn't just money and jewelry. It's used in electronics, in medical devices, in aerospace applications. As technology advances, industrial demand for gold is increasing, and that demand is relatively inelastic, meaning companies need gold regardless of the price. They'll pay what they have to pay to get it. So you've got investment demand surging, industrial demand steady to rising, and supply constrained. That's a recipe for significantly higher prices. Now, let's talk about what this means for your personal financial situation. Most people have their wealth concentrated in a few areas: their home, their retirement accounts, maybe some savings in the bank, and all of those are denominated in dollars or tied to dollar-based assets. That's not diversification, that's concentration. You're essentially making a massive bet that the dollar will maintain its value and that the financial system will remain stable. And maybe that bet pays off. But what if it doesn't? The wealthy don't think this way. They spread their wealth across multiple asset classes, multiple currencies, multiple jurisdictions. They own real estate in different countries. They hold precious metals. They have offshore accounts. They're not doing this because they're paranoid. They're doing it because they understand that concentration is risk. And here's the beautiful thing about gold. It's the ultimate diversifier. It moves independently of stocks and bonds. When the stock market crashes, gold often rises. When currencies weaken, gold strengthens. It's insurance against the exact scenarios that would devastate a traditional portfolio. Think about what happened in 2008 during the financial crisis. The stock market got cut in half. Real estate collapsed, banks failed, people lost their jobs, their homes, their retirement savings. It was devastating. But gold? Gold went up. Not immediately, but over the course of the crisis and its aftermath, gold more than doubled. Or look at what's happening in countries with currency crises. In Venezuela, in Argentina, in Turkey, when the local currency collapses, people rush to gold. It's the lifeboat when the ship is sinking, and the people who had gold before the crisis were the ones who preserved their wealth. You might be thinking, but that can't happen here. We're the United States. We're different. And you're right, we are different. We're the country with the reserve currency, which means when our currency fails, it doesn't just affect us. It affects the entire world. The consequences are actually bigger, not smaller. I want to be clear about something. I'm not saying the dollar is going to zero tomorrow. I'm not saying the financial system is going to collapse next week. What I'm saying is that we're in a transition period, and transitions create both risks and opportunities. The risk is being caught unprepared when the shift happens. The opportunity is positioning yourself ahead of the shift so that you benefit from it instead of being hurt by it. And that's what the central banks are doing. They're not panicking. They're methodically, systematically building their gold reserves because they know what's coming. They're reading the same economic data you and I can read. They're seeing the same unsustainable debt levels. They're watching the same geopolitical tensions, and they're acting on it. The question is, are you going to act on it too? Or are you going to wait until everyone else figures it out and the price is twice as high? Here's another angle to consider: the generational wealth transfer that's happening right now. Baby boomers are retiring and passing wealth to the next generation. That's trillions of dollars changing hands. And the younger generation thinks very differently about money than their parents did. They've seen two major financial crises in their lifetime. They've watched their parents lose money in the stock market, struggle with underwater mortgages, worry about retirement. They're skeptical of traditional financial institutions, and they're much more open to alternative assets. This generational shift is going to accelerate the move into hard assets like gold, because the people inheriting wealth aren't just going to park it in the same mutual funds their parents used. They're going to diversify. They're going to seek out assets that can't be manipulated by central banks or devalued by government policy. And this brings up an important point about how you actually hold gold. There's a big difference between owning gold in a vault somewhere with your name on it and owning shares in a gold ETF. With an ETF, you own a claim on gold. With physical gold, you own the actual metal. In normal times, that distinction might not matter much, but in a crisis, it matters enormously, because when things get chaotic, when systems start breaking down, you want to own the real thing, not a paper promise. You want to be able to hold it, move it, use it if necessary. This is why serious gold investors focus on physical metal, coins, bars, stored in secure locations. It's not as convenient as clicking a button to buy an ETF, but it's real, it's tangible, it's yours. Now, I know what some of you are thinking. Gold doesn't pay dividends. It doesn't generate cash flow. It just sits there. And that's absolutely true. Gold is not an income-producing asset. It's a wealth preservation asset. It's insurance. You don't buy insurance expecting it to make you rich. You buy insurance to protect what you already have. And in an environment where currencies are being debased and financial systems are under stress, gold is the ultimate insurance policy. But here's the thing. Insurance that also appreciates in value is pretty attractive. And that's exactly what gold has been doing. It's preserving wealth and growing wealth simultaneously. That's a rare combination. Let's talk about timing for a moment. People always want to know, is now a good time to buy? Should I wait for a pullback? What if it drops after I buy? Here's the reality. Trying to time the market perfectly is a fool's errand. Nobody can consistently predict short-term price movements. What you can do is look at the long-term fundamentals and make a decision based on those. And the long-term fundamentals for gold are stronger than they've been in decades. The debt is higher. The money printing is more aggressive. The geopolitical tensions are more severe. The de-dollarization is more advanced. All of these factors point in one direction: higher gold prices. Could gold pull back in the short term? Sure, markets don't move in straight lines. But if you're buying gold as a long-term hedge, as insurance, as a wealth preservation tool, then short-term fluctuations don't really matter. What matters is having the position before the next major crisis hits. Because here's what happens in a crisis. Gold becomes hard to find. Premiums spike. Delivery times extend. Sometimes dealers run out of inventory completely. And by the time you realize you need gold, it's too late to get it at a reasonable price. The smart move is to build your position gradually over time, regardless of short-term price movements. Dollar cost averaging into gold, just like you would with any other investment. That way you're not trying to time the market. You're just systematically building a position. And here's something else to consider: the psychological aspect of owning gold. There's a peace of mind that comes with knowing you have real assets that can't be printed away or devalued by government policy. In uncertain times, that peace of mind is valuable in itself. I've talked to people who lived through hyperinflation in other countries, and they all say the same thing. The people who had gold were the ones who survived with their wealth intact. The people who trusted the system, who kept their money in banks and government bonds, they lost everything. Now, I'm not predicting hyperinflation in the United States, but I am saying that the risk is higher than most people realize. And the cost of being wrong is catastrophic. So even if there's only a small chance of a currency crisis, the prudent move is to have some insurance. Think about it this way. If you have homeowner's insurance and your house never burns down, you don't consider that a waste of money. You consider it smart risk management. Gold is the same thing. It's risk management for your financial life. And unlike homeowner's insurance, which is pure cost, gold has historically appreciated over time. So you're getting insurance that also has the potential to grow in value. That's a pretty compelling proposition. Let me give you one more perspective on this. Throughout history, every fiat currency has eventually failed. Every single one. The average lifespan of a fiat currency is around 27 years. The dollar has been a pure fiat currency since 1971. That's over 50 years. We're already well past the historical average. Does that mean the dollar is going to collapse tomorrow? No. But it does mean we're in uncharted territory. And in uncharted territory, having a backup plan is essential. Gold has been money for 5,000 years. It's survived the fall of empires, the collapse of currencies, wars, depressions, everything history has thrown at it. And it's still here, still valuable, still trusted. That's not a coincidence. That's because gold has properties that make it ideal as money. It's scarce, it's durable, it's divisible, it's recognizable. And most importantly, it can't be printed or created out of thin air. When you own gold, you own something real, something that has intrinsic value, something that will still be valuable long after today's paper currencies are forgotten. So here's the bottom line. Gold at $4,000 isn't expensive. It's repricing to reflect the reality of our current monetary system. And based on the fundamentals, based on what central banks are doing, based on the trajectory of debt and money printing, this repricing has a lot further to go. The question isn't whether you should own gold. The question is how much you should own and how quickly you should build that position, because the window of opportunity to buy at these levels might not stay open for long. Central banks are buying, institutional investors are buying, wealthy individuals are buying. They're all moving in the same direction, and they're doing it for a reason. They see what's coming, they understand the risks, and they're taking action to protect their wealth. The only question is, are you going to join them? Or are you going to wait until it's too late and wonder why you didn't act when you had the chance? This isn't about getting rich quick. This is about protecting what you've worked your entire life to build. It's about making sure that when the financial system goes through its next crisis, and it will, you're on the right side of that crisis. You're positioned to preserve your wealth instead of watching it evaporate. Gold isn't a speculation. It's not a gamble. It's the oldest, most proven form of wealth preservation in human history. And right now, at this moment in time, it's more important than ever. So, before you buy anything else, before you make any other financial decision, ask yourself, do I have adequate protection against currency debasement and financial system instability? Because if the answer is no, then gold should be your next purchase. Not tomorrow, not next week, now. The central banks aren't waiting. The smart money isn't waiting. And you shouldn't wait either, because by the time everyone else figures this out, the price will be significantly higher, and the opportunity to protect your wealth at today's levels will be gone.